Dear family, please have a seat. We need to talk about our money. We need to become financially stable and keep growing our wealth together. This is my story about my finances and how I've learned to stay stable. But more importantly, this is about sharing something incredible with you. The greatest investment studies ever conducted that can change your financial life forever. I'm always studying every single day to grow in this area, not just to keep myself in a better place, but to help each of you as well. Today, I'm going to share all the research and teachings I've gathered since I was 24 years old, now at 40 years old. Studies made by the world's greatest financial teachers, governments, and university scholars. And here's the proof it works. I'm still following and studying these principles, and for the last 5 years, I've been teaching others through my own firm as a personal manager in all areas of life. You see, as a single mother of 4 young boys, I had to figure this out. I work about 50% of my time for income, 15% creating content to inspire others like you, 10% studying and investing in our future. And the rest is for me and kids as extra family time together. I invested in one big shared house that now brings in half our monthly income, plus pays its own mortgage and covers our primary home expenses. And also invest for each of my kids separately and invest for myself, all with small amounts but consistently for 15 to 20 years of growth. We're financially stable now, with a little set aside for fun times and emergencies. The investments for my kids? Those are for when they start their own lives. Mine will be extra pension money and fun time security, plus support for my kids and future grandchildren when needed. But here's what I want you to understand. This isn't about my story. This is about the science behind building wealth. Over the next 8 parts of this series, I'm going to share with you the most important financial research ever conducted. We'll explore Harry Markowitz's Nobel Prize-winning modern portfolio theory that changed investing forever. Eugene Fama's efficient market hypothesis that proves why simple beats complex. The power of compound interest that Einstein called the 8th wonder of the world. John Bogle's revolutionary index fund research, and the behavioral finance breakthroughs that show why our emotions can destroy our wealth. These aren't my opinions. These are proven scientific studies, backed by decades of research from the world's top universities and Nobel Prize winners. Studies that show you exactly how to build lasting wealth, regardless of how much money you're starting with. My story? It's just proof that these methods work for real people, in real life, with real challenges. I'm a single mother who started with very little. If I can do this, following these time-tested principles, so can you. Over the next 7 parts, we'll dive deep into each of these life-changing studies. You'll learn the exact strategies that have created more millionaires than any other investment approaches in history. And by the end, you'll have a complete blueprint for financial independence. So buckle up, family. We're about to embark on a journey through the greatest investment studies ever conducted, studies that will transform how you think about money, wealth, and your financial future. His is the greatest investment studies, and your financial education starts right now. In our next part, we'll explore how one mathematician's breakthrough in 1952 revolutionized investing forever, and why putting all your eggs in one basket might be the biggest financial mistake you'll ever make. Modern portfolio theory, the science of smart diversification. Welcome back, family. In 1952, a young mathematician named Harry Markowitz changed investing forever with one simple question. What if we stop focusing on picking the best single investment and instead focus on how different investments work together? You've heard, don't put all your eggs in one basket, right? Well, Markowitz proved this mathematically. He won the Nobel Prize for showing us exactly how to build the perfect basket. Here's what he discovered. And this is where my own journey really began. When I was starting out as a single mother, I had very little money to invest. I was tempted to put everything into one sure thing, maybe just one stock or one property. But Markowitz's research showed me something incredible. By spreading my small amounts across different types of investments, stocks, bonds, real estate, I could actually get better returns with less risk. Think about it this way. If you put all your money in one company's stock and that company fails, you lose everything. But if you spread that same money across 500 companies and even 50 of them fail, you still have 450 winners carrying you forward. This is exactly what I did with our family's investments. Instead of trying to pick the perfect stock for each of my boys' accounts, I invested in broad market index funds. These funds automatically give us pieces of hundreds or thousands of companies. Markowitz called this the efficient frontier, the sweet spot where you get maximum return for the level of risk you're willing to take. It's like having the perfect recipe that balances all the ingredients just right. When I invested in our shared house, I didn't stop there. I also put money in stock market funds, some in safer bond funds. Why? Because real estate and stocks don't always move in the same direction. When one goes down, the other might go up, protecting our family's overall wealth. Here's the mathematical beauty Markowitz discovered. Two investments that each have the same average return but move in opposite directions can be combined to give you the same return with much less ups and downs, less stress, better sleep, more predictable outcomes. The research is crystal clear. Over the past 70 years since Markowitz published his study, diversified portfolios have consistently outperformed single stock investments. Not sometimes, not usually, consistently. So how do we apply this today? Simple. Instead of trying to pick individual stocks, which even professional fund managers get wrong 85% of the time, we invest in broad market index funds that give us instant diversification. For my boys' future, I don't gamble on individual companies. I invest in the entire economy's growth through diversified funds. When they're ready to start their lives in 15-20 years, they'll benefit from the growth of hundreds of companies, not the success or failure of just one. This is the foundation everything else builds on: family. Modern portfolio theory isn't just academic research. It's the scientific proof that smart diversification beats risky speculation every single time. Markowitz showed us that we don't need to be investment geniuses. We don't need to predict the future. We just need to spread our risk intelligently and let the mathematics of diversification work for us. Next time, we'll discover why trying to beat the market might be the biggest waste of time and money in investing history. We're going to explore Eugene Fama's efficient market hypothesis, the research that will save you from making costly mistakes. Ohming up. The Nobel Prize-winning research that proves why 85% of professional fund managers can't beat a simple index fund, and what this means for your family's financial future. Efficient market hypothesis. Why simple beats smart. Have you ever wondered why, despite hours of research, professional fund managers rarely beat the market? Welcome to Part 3, where we uncover the secret behind market prices and why simple beats smart. Picture the stock market like this roller coaster. Prices whip up and down based on every piece of news, from company earnings to global events. According to Nobel laureate Eugene Fama, this wild ride isn't random chaos, it's efficient chaos. In 1970, Fama proposed the efficient market hypothesis. He showed that markets instantly absorb all available information, so prices always reflect true value. That means tomorrow's price change is as unpredictable as a coin flip, heads or tails. Just like that, stock returns can't be forecast by studying last month's prices or analyst predictions. Fama defined 3 levels of market efficiency. Weak form, past prices don't predict the future. Semi-strong, public news is instantly baked into prices. Strong form, even insider info can't outsmart the market. The greatest investment studies. Efficient market hypothesis. Have you ever wondered why, despite hours of research, professional fund managers rarely beat the market? Welcome to Part 3, where we uncover the secret behind market prices and why simple beats smart. Picture the stock market like this roller coaster. Prices whip up and down based on every piece of news, from company earnings to global events. According to Nobel laureate Eugene Fama, this wild ride isn't random chaos, it's efficient chaos. In 1970, Fama proposed the efficient market hypothesis. He showed that markets instantly absorb all available information, so prices always reflect true value. That means tomorrow's price change is as unpredictable as a coin flip. Heads or tails? Just like that, stock returns can't be forecast by studying last month's prices or analyst predictions. Fama defined 3 levels of market efficiency. Weak form. Past prices don't predict the future. Semi-strong. Public news is instantly baked into prices. Strong form. Even insider info can't outsmart the market. Radical. It's battle-tested. Over decades, Fama's efficient market hypothesis has saved families like ours from costly mistakes and false promises. In Part 4, we'll dive into the magic of compounding, Einstein's so-called 8th wonder of the world. You'll learn how tiny, consistent steps turn into financial mountains over time. Get ready to see how $50 a month, invested wisely, can become enough to fund your family's dreams decades down the road. Part 4, Compound Interest, Time's Exponential Power. Welcome back. In Part 4, we unlock the 8th wonder of the world, compound interest. This principle turns tiny seeds into towering forests of wealth over time. Imagine this sapling as your money. If you water it with just a little each month, it grows branches, and those branches sprout leaves that catch rain to grow even more. That's compounding in action. Mathematically, compound interest means you earn returns not only on your original investment, but also on the returns that investment generated. Your money earns money, again and again. Let me show you a simple shortcut. The rule of 72. Divide 72 by your annual return rate, and you get the approximate years needed to double your money. For example, at 8% growth, your money doubles every 9 years. 72, 8 were a 9. That means if you invest $100 today, at 8% annual returns, it becomes $200 in 9 years, $400 in 18 years, and $800 in 27 years, just by staying invested. For my boys' accounts, I started when they were toddlers. Even small monthly deposits, say $50, grow exponentially over 15 to 20 years. They may not notice now, but when they're adults, they'll have tens of thousands, maybe hundreds of thousands, waiting for them.
At a 7% return, investing $50 a month grows to about $32,000 over 20 years, and that's just one account. Multiply by 4 kids, and we're talking real financial legacies. For myself, I treat my Me Fund the same way. Even if I can only spare $100 a month, compounding turns meager beginnings into a reliable future nest egg for retirement, and maybe some fun along the way. Here's the key: start early, be consistent, and let time do the heavy lifting. The longer you leave your money invested, the more powerful compounding becomes. This is why I love teaching financial stability. With our shared house, index funds, and kids' accounts, we're harnessing 3 compound engines at once: real estate income, market returns, and time itself. Next up, Part 5. We'll explore index funds and the passive investing revolution sparked by John Bogle. You'll see why low-cost funds beat active managers nearly every time. Stay tuned to discover how you can own the market with just a few clicks, and watch Michael Bogle's genius transform tiny fees into huge gains.